Great. We are live. Good afternoon, everybody. I'm Shannon Spotswood. I am the president of RFG Advisory. And the first debate is tonight. So we thought it was the perfect day to host a webinar on the 2020 election and what it means for the stock market, certainly the topic that is on everybody's mind. A couple of housekeeping items. We will be monitoring the chat function located on the webinar. So if you have a question, please feel free to drop a note into that chat box. And we are recording this webinar today. Let's get the ball rolling. I'm excited to introduce our two speakers. We have Rick Wedell and Bill Levant. Rick Wedell is the Chief Investment Officer of RFG Advisory. Many of you on this call are familiar with RFG. We are a Financial Times FT Top 300 RIA. We serve independent advisors and their clients and manage in excess of $2.2 billion. Rick graduated magna cum laude from Harvard University. He earned his MBA from Stanford University, where he was the Henry Ford Scholar, so basically the smartest guy in his class at Stanford. Prior to joining RFG as the Chief Investment Officer, he spent 12 years at Bain Capital and helped them to become the global powerhouse that they are today, managing in excess of $30 billion. Bill Levant is the Chief Investment Strategist at Arlington Family Offices. Arlington serves clients with a net worth in excess of $50 million and manages $5.5 billion. They were recently named by Financial Advisor magazine as one of the top 50 fastest growing RIAs in the country. Bill is a chartered financial analyst and has his MBA. And prior to joining Arlington 14 years ago, he has 20 years of investment experience as a chief investment officer and an M&A banker. So we've got two powerhouses on the call today to talk about the market. To kick you guys off, talk to us about the various scenarios for 2020.
Thanks, Shannon, and I always appreciate the introduction. And Bill, just jump in anytime here, but I thought I'd just kick us off with, thinking about for the 2020 election, it matters not only who wins the presidential election for obvious reasons, but it also a lot of the outcomes really hinge on the outcome in the Senate. The House, because you can't obviously create legislation and pass legislation without control of, or at least without it, you can't pass legislation without compromise unless you have control over both the House, the Senate, and the executive branch. So it's really important as we think about the 2020 election to really think about which way each one of those goes. And as a starting place for that, we thought we'd introduce, you can never have one of these conversations without, making people angry about one direction or another on the prediction. And so what we thought we'd do for today's conversation is introduce everybody on the call, if they're not already familiar with it, to a website called predictit.org. Which is essentially a little bit of a gambling website. It's a betting website where you can bet on the outcome of a lot of different elections around the country, all of the House races, all of the Senate races, all of the presidential race in particular. You can bet not only at a national level, but you can also bet at the state level. And basically, the way this works is that you go in and you see, if you think that you bid on these contracts, and then if the individual that wins actually winds up winning that, then you get $1, right? So you can bet that the president is going to win, that the current sitting president is going to win. That bet is currently at about 44 cents. And if he does win, you get $1. And if he doesn't win, then you lose everything. And so it's one of those things, we're going to use this as a predictor of odds for the election, which is an interesting thing, because if you think that the odds that I'm giving you are wrong, you're more than welcome to put your money where your mouth is. Once again, it's predictit.org. And you can go there and place your bets on the other side. So currently, odds in the presidential election are right around that 44-56 range. That has been narrowing up over the past couple of weeks, but Biden is a little bit in the lead. And if you don't believe it, then obviously you can log in and place your bets in the other direction. And then if I flip to, and that's the electoral college map that's currently on your screens right now. It basically goes down on a state-by-state basis and says, okay, which states do you think are going to go Republican? Which states do you think are going to go Democratic? And where do you think the electoral college is actually going to break? In the Senate, on the other hand, you can see this map, which is basically too close to call. It would be 50 seats in one direction, 50 seats in another. It's essentially a toss-up as to who wins the Senate. And then I'm not even going to show up the House map because the House is essentially, it looks very strongly like it will go Democratic at this point. So with those odds, Bill, I don't know if you have anything to chime in here, but with those odds, I thought we could talk a little bit about, what are the implications of either, what are the implications of those two, depending on, who wins the Senate and then also who wins the presidency.
The only thing I would add is there's lots of different predictor models out there from Bloomberg to different baskets of stocks that Goldman may put out. Bloomberg is showing a Biden victory by 6 points over Trump. That has been cut in half over the last month. So you look at where the spread is certainly in Biden's favor, and you also look at the trend, which tentatively, seems to be in Trump's favor. An interesting, anecdote, that, one of the basket models that, Goldman, produces is those stocks that have higher tax rates versus lower tax rates. And so that's kind of a differentiator between the Democrats and the Republican policies. And so that, right now, that's showing that a 53% probability of tax reform, which would indicate a likelihood of a Biden win. So there's some interesting things out there. They vary a little bit, but they're all kind of saying the same thing. One interesting thing is no incumbent in modern history has ever been reelected when there's been a recession that's taken place in the last 2 years. So clearly there has. This recession is different. It's more of an event type recession rather than a deep economic recession that drove it. So take that for what it's worth.
And I think it's also worth just worth noting that all of these polls would indicate with still months or at least a little over a month before the election, this is really too close to call. This is one where the outcome is certainly not certain, and particularly in the Senate, trying to narrow down exactly who's going to have control of that. Come 2021 is something that I think most people really just it's too far out to call, and it's really neck and neck right now on a state by state basis. So it bears paying a little bit of attention to what are the implications for the various scenarios that are out there. And I think here we just start to just to try and guide a little bit of framework. Obviously, you have the presidency. So is that Biden or Trump? But then in order to get any type of major legislation passed, including tax reform, if you're Trump, it's going to be difficult because the House will almost certainly be Democratic. And so, if you look at the legislative reform that we've been able to pass in the past 2 years with a Republican Senate, Democratic Congress, and the Republicans in the White House, the answer is not that much because you can't get all three to agree. And I think the same would be said for either a Trump presidency with a Democratic House or Senate, or a Biden presidency with a Republican Senate. In both of those cases, you're going to wind up with gridlock, and so you're not going to wind up with the type of massive reform packages, tax reform, this and that are more indicative or more likely to happen when one party has sort of unilateral control. And once again, the Senate race is sort of too close to call. So it kind of leads, me, at least in my head, to, sort of three scenarios. And then we'll talk about a fourth one, which is a little bit scarier. But, the first is Trump's the president, and, you maybe have a Republican Senate. Whether you have a Republican Senate or a Democratic Senate probably doesn't matter all that much. You're just going to wind up with gridlock because you're almost certainly going to have a House that's Democratic. You have a Biden presidency with a Republican Senate. Once again, that's probably a little bit of gridlock, in terms of legislative, outcomes. Maybe not on the regulatory front. And then the last scenario that we'll consider is kind of a Biden presidency with the Democratic grand slam, if you will, a Biden presidency, a Democratic Senate, and a Democratic House. And I thought, Bill, maybe we could take a little bit of time to just talk through, maybe how the markets might react to each one of those scenarios.
Yeah, that sounds great. I mean, if you look at, a as is type White House and Senate where, Trump remains president, you could have a continuation of, a moderate melt up in the markets possibly, but you may have some level of civil unrest. I mean, we've been seeing it now for months, and a continuation of Trump, might have some short-term impact. I would think on the civil unrest that we're currently seeing. But these are more short-term issues.
Yeah, and I think, it's worth noting that the market hasn't really responded a whole lot to civil unrest. Granted, it's been a little bit more contained. It's not widespread across all 50 states, et cetera. But, the market has tended to take a little bit of that civil unrest as what I'd say, a Main Street event, not a Wall Street event, if you will. So certainly something to think about. But I agree with you. I think a Republican presidency with gridlock in, the Senate or in the House is probably a continuation of a little bit of a melt up of the market, maybe even a little bit of a relief rally, depending on how much the market is sort of expecting, quote unquote, a Biden win, or at least wasn't expecting the Trump. Whenever we get these uncertain outcomes, you might see a little bit of pop in one direction or another. So talk to me a little bit about maybe a Biden president, but a Republican Senate. What do we think that looks like?
I think the market has part of that priced in right now. I think you're seeing that in the probabilities, though. In the back of everybody's mind is what happened in 2016, where the same situation happened. Potentially this time, maybe it's a little different. I think I've seen those people that are undecided. I think there may be a smaller number this year than there was in 2016, so that may have an impact. But then on the other side, I know you've got a lot of Trump supporters that remain quiet until voting day. So if Biden wins and the Senate remains red, I think, as you said, it's a gridlock. I think that's good, generally good for the market. If we see a sweep, then then you got to worry about if there's any if it gets contested, and so there's a whole bunch of other uncertainties that markets generally don't like. And then the layer on top of that, you've got the vaccine news coming out roughly around that time. So if you look at kind of the volatility spreads in the options market right now, it's basically saying that on election day there'll be about a 3% move in the market, which you would say is not that big a deal, which it's not.
That's right.
But then I think the market is expecting a more elongated results process, either because you've got the ballots that take longer to get counted this year, or you have maybe a contested election. So there's some uncertainty there.
Yeah, and I think that that's going to be an interesting thing to play out. We highlighted a couple of those, and I just want to break apart a little bit of what you just talked about. So I agree with you. In a scenario where you've got a Biden presidency but a Republican Senate, once again you got gridlock. You're pretty sure nothing's going to happen for the next 2 years. And you might see a little bit of regulatory reform, so some beefing up of the EPA and some things like that I think the Trump administration worked very hard to sort of loosen red tape. I think you might see some of that come back in, but overall I think the market sort of grinds slightly higher in response to that gridlock. We talk about it over here all the time. The market loves gridlock. I think in a blue sweep, if you will, the market probably reacts somewhat negatively to that. I think it's no secret that the Democrats would like to repeal some of the corporate tax cuts that were put into place in the first half of the Trump administration. So I think that that was about plus or minus about 10 percentage points worth of earnings in the S&P 500, and so taking that away obviously has implications for the market. It's unclear to me whether or not the market, though, what the Democrats can do, at least in the short term, given that they're still talking about a several $1 trillion stimulus package that needs to be passed for virus relief, and so. There is a little bit of, what if the Democrats win, but then pass $2.5 trillion of spending along with, maybe a vaccine that comes out or positive news on a vaccine at that same time. Does that necessarily mean that the market crashes? No, I don't actually think so. I think the virus data might actually trump a little bit of the tax data, or at least expectations around tax data. And then the last scenario that you mentioned, which I think is actually the scariest, and maybe one that we're likely to see, candidly, just given the mail-in procedures, is that of a contested election, and not even necessarily a contested election nationally, but depending on how close some of these Senate races are, you're going to have the entire party with their eyes on, states like North Carolina, states like Florida, states like Georgia. Where there may be a tight Florida, apologies, but Georgia, North Carolina, et cetera, where there are some tight Senate races that the entire party is going to have an interest in. It's not just that state, and so I think that there may be a little bit of a period of uncertainty after the election, and markets are volatile during uncertain times. So that's not that uncommon. But I do love, what you brought up, which is, option spreads currently would predict that, on election day, you're going to get a plus or minus 3% move, and that's not huge. Which kind of brings us to the next topic, which is, the question that I get all the time, should you, if you were me, or if I were you, or if we were playing around with our own portfolios, have you moved entirely to cash at this point based on the election, or are you staying the course a little bit?
No, you can't time the market even in this situation. The politics is very dynamic, and you got the vaccine, you got all sorts of stuff that come into play here. So you don't know. You don't know the direction. You never know the direction of the market in the short term, and even over the long term, elections are just not a big enough deal to move markets over the long term to where you should exit and try to time this thing. No, I don't. We're not. We have seen a quite nice run up from the March 23rd trough, and so we have rebalanced and, reduced some exposures in particular areas like, we think, high yield bonds are kind of fully priced right now. So we've reduced some of that exposure, but we've got, good exposure in, international markets, which won't be, certainly as impacted as U.S. markets will be in this situation.
No, and I agree with that. Like anyone who's ever heard us speak before has known that we're not market timers. We don't advocate it. And I think that, it's just one of those things where you don't necessarily know how the market is going to interpret a particular outcome or what other exogenous events might occur in and around the election that might influence the direction of the market one way or another. There's obviously a virus out there, and positive news on the development of a vaccine or positive trends in case data or whatever that might look like in early November or mid-November might actually trump the outcome of the election. No pun intended. Based on the anticipated economic activity that occurs on the outside of it. And I think, you make a great point, which is in a weird way, elections are kind of no big deal, at least in the context of the overall market path. I forget which one of I think it was maybe Lincoln Financial that came out with a piece of research earlier this year that basically just went back and showed, the returns of the market over various presidencies, whether they were Democratic, Republican, et cetera. And they basically concluded that there's very little predictive power in terms of the market direction and the magnitude of the market increase based on knowing the outcome of an election result. So certainly, if you go over a 4-year time frame for presidential elections and say, okay, are Democrats good for the market, or are Democrats bad for the market, or Republicans good, or Republicans bad? If you look at it with any type of statistical, mathematical hat on, you'd pretty rapidly conclude that the data is just not predictive. And I think that, for most of our investors, certainly for any investor who's got a longer term focus, this is just one of those types of things that you probably want to ride out. And you certainly don't want to do anything drastic within your portfolio to say, okay, now's the time to move to cash, or now's the time to be fully invested, or this and that and the other. If you want to make those types of bets, then there are various wagering outcomes that you can use out there. We mentioned predictit.org. There are some others that are out there, but I wouldn't certainly do it with your nest egg. That said, maybe you can talk, I know you started to talk a little bit about it, but maybe you can talk a little bit about what you're doing in your own sort of client accounts. Like, you've talked a little bit about some trades that you've made, and we'd love to hear, a little bit more about other activity that you're doing in response to, the situation. So one point to make in your prior question was, I pulled some numbers this week on, back going over the last, 60 years. And I looked at the forward 12-month returns during every election year. And it's kind of interesting. There's only been 2 times in history where the market was not positive over the following 1 year from an election. That was 1980 and then 2000 for obvious reasons. But looking at portfolios now, you certainly need to be prudent. You need to always think long term. I think we've talked about, over the long term, elections just, aren't all that significant. So I wouldn't spend a lot of time on that, other than to think about, well, if you're sitting on a lot of cash right now, you may think it's more prudent to kind of hold at least the majority of that cash till around election time or after election time to get a little more comfort, depending on your time horizon there. And then the other thing would be, make sure that for those investors out there, make sure that you're talking to your advisor, particularly if you have significant spending needs over the next, 12 to 24 months, because nobody can predict where the market's going at that point. So you may want to,
do some harvest some profits, now rather than, wait for, the election in a couple of months for spending needs.
Yeah, and I think that's probably, that's great advice for candidly any time, any situation. If you know that you have spending needs that are in the next, 12 to 24 months, to kind of think about, setting aside cash or reducing risk in your overall portfolio to be able to fund those kind of near-term needs. I think that it's it's great advice just in general, and hopefully, you're in enough regular contact with your advisor that your advisor is kind of aware of what those spending needs look like, and, has made accommodations within your portfolio to make sure that that cash will be available for you when the time comes. I think it's great data, and it's absolutely spot on in terms of thinking about a 12-month return after an election, and 80 and 2000 are obviously cases where economic activity trumped election activity, and that's frequently the case. When you think about returns over presidential cycles, a lot of that is really just driven by what were the underlying macroeconomic forces at play in the economy at that point in time in history. And economic cycles, at least in the modern era, tend to be a lot longer than presidential cycles. And so, it's just once more one of those things. You can't predict the timing of a recession, but recessions and the subsequent recoveries are what really drive market, meaningful movements in the market, not necessarily, elected activity. But that said, I know that we have both done some things in the portfolios. On our end, we've been rebalancing pretty consistently over time as the market's moved. We rebalanced back in March when the market was at its lows. We rebalanced again in the May-June timeframe to take a little bit of money off the table. And as we go in, as we get closer to election, depending on how the market moves, we may choose to rebalance again to see whether or not it's appropriate to take a little bit more, just get everybody back in line with their risk tolerance, given that the market's run up since May, June. Talk to me a little bit about, are there particular sectors or areas in which you guys are focused on as either, shelters from the storm or places to, take advantage of, as you look at November?
Well, we generally are focused on higher quality companies overall. I'd say we're certainly more biased these days to larger cap companies that can really take advantage of the situation that's playing out right now and can really add to their competitiveness over time. We're not big sector players, so to speak. But if you kind of looked at the different sectors and you look at the tax packages that are being put in place, Biden's tax package will have the greatest effect in a negative way in the IT and healthcare space. On the positive side, he is doing some interesting things on healthcare policy. So, outside of tax, that may negate the tax effect there for healthcare. Infrastructure is going to be big in both parties. Biden's going to have a better impact in renewable energy and municipal bonds. If Trump wins, you kind of go back to the old tried and true firearms retailers will probably continue to do well. Personal security companies will probably do well. We don't spend a lot of time on sectors. We do a good bit of geographic exposure analysis, and so we do have a fairly strong bent on the international side, because that's where, valuation seems to be much better, much lower than where we are in the U.S. But there's a lot of opportunities. You got to peel back the onion. It's crazy to say that the top 5 S&P 500 companies are up 35% year to date, and the other 495 are down 4 or 5%. So there is opportunity. You just have to kind of maybe look away from the momentum-driven sectors in tech and consumer discretionary sectors that have kind of led the market over the last 1, 3, 5, 10 years, quite honestly, because they may be the first to get hit. But if you look at past experience, a lot of this stuff reverses pretty quick. So again, it's policy is important. It's probably more important for the longer term. My concerns right now are really more for our kids and grandkids. We're just I'm certainly more fiscally conservative, and it just seems like whichever party you do vote for, they seem to be spending like drunken sailors.
It is true. And there's a lot that I want to unpack in what you just said. So we'll come back to the drunken sailor comment last. But I think, first off, just on the infrastructure side, it is really surprising to me. You would have thought that this is something that both parties can get behind. Both parties have been talking about the need for infrastructure spending really since 2016. Certainly in 2018, you would have thought that it would have been the one place that the administration would have looked at and said, okay, this is something for the second half of the presidency. This is something that we could do, right? Because the Democrats and the Republicans both agree on the need for additional infrastructure spending. And it just hasn't happened, right? Whether it's tied up in various other things, it's always something that can get put off, whatever it might be. It's just we have not been able to get an infrastructure package passed. And I am hopeful. It's something we need. It's something that would obviously be positive for the economy in a myriad of different ways. And so I'm hopeful that we get that spending package, but I sometimes question whether or not it'll actually come to fruition or not, regardless of who's in the presidency. Because there just always seems to be something that's out there that the administration and Congress wants to focus on more, which has been shocking to me. And I think the same in a weirdly different vein, the same a little bit can be said about international markets, valuation gap between international and the United States. I totally agree with you as a place to sort of increase a little bit of exposure going into the election. It's certainly, the French or German stock market is certainly not going to be impacted as much by the outcome of the U.S. Versus, the domestic market. But that said, I think all markets are pretty well correlated at this point. So it's not like it escapes it entirely. And the second thing that I would say is that valuation gap has been persistent now for several years. And so it's one of those things where, we've thought about it, we continue to evaluate it, but we haven't made that move sort of wholesale just yet. On the drunken sailor side, I agree with you. But I also think that the response to the virus was necessary at the time. We needed the stimulus spending to avoid that sort of, self-fulfilling cycle of economic slowdown. And I think the government has done a nice job of, preventing what I would call the sort of all-out, depression style scenario when you see, U.S. GDP drop by 30% in a quarter, which is something that's literally never happened before. I think that they did a nice job of providing that stimulus and stepping in so that there's, something there to backstop the economy and turn us around to get us, 15 or 16% growth in that next quarter, which is also something you'd never really seen before. I would agree with you, though, that I think the timing and delivery of the next stimulus package may be a little bit too much and a little bit at the wrong time. depending upon depending on the course of the virus. So I totally agree with that statement. On our side, we talked a little bit about that. I agree with you. We tend to be a little bit, I'll put it this way. We've been a little bit underweight small caps, through this cycle, for a variety of reasons. So talk to me maybe a little bit about your thoughts on that space.
Yes. So I mentioned that we are very materially leaning more towards the large caps. So we do have limited exposure on small caps right now. There's a lot going on in the economy, and small caps usually get hit the first. And if you look at a lot of the statistics that we're looking at, there's hundreds of thousands of small businesses that have shuttered over the last 6 months, and a half or more are not coming back. And you're seeing increases in credit defaults more than in 2008, but it's not really having a huge impact on the market just yet. Those sort of defaults may play out over the next 12 months or so. It's not necessarily immediate, but all this stimulus, while it is good and needed, I do agree with you. And certainly in the first tranche, the QE tranche that they did a few months back, it was needed. What it's also doing, it's providing liquidity for those companies that really don't deserve to stay alive. These are companies that are continuing to get that liquidity from the market when they're not profitable, and in a normal environment, they would not continue, or they'd get bought out, or what have you. So you need to be especially careful on the credit side, right now as well.
I agree. I totally agree with that. I think that there's one of the difficulties with the Fed providing a liquidity backstop for folks is that they can't be seen as playing favorites, right? Like they refuse to step in and do the work that the market would normally do to say, this company needs to go bankrupt, but that company is okay and we should save, right? Normally the market is the one that steps in and decides who lives or dies. Based on their financial strength and the prospects for that business going forward. And it's just, it's a capitalistic market. And when the market starts to panic, the Fed's forced to step in and say, okay, the market isn't functioning effectively right now because, effectively it's going to deny credit to everybody. That's not the case. So we're going to step in and flood the market with liquidity so that panic element gets out of the market. And I would agree with you that the unfortunate consequence of that, or the side effect of that, if you will, is that the market may provide liquidity to some companies that don't really deserve it at the end of the day, and eventually that sorts itself out. But the sorting out can be a painful process towards the end.
Exactly.
Shannon, are there any questions on the chat that we should try and look at and address?
There are no questions currently. If anyone does have a question, please feel free to pop it into that chat box.
Awesome. I'll give a few seconds to see if there's anything else that people want to address. If not, we're right up around 45 minutes.
Rick, I think you're clear. I don't see any questions coming in.
Awesome. Well, great. Well, Bill, is there anything else that you want to touch on with respect to the election?
No, I think we talked a good bit about all that. It'd be, I guess tonight's debate will be one of the most watched TV shows this year, I bet.
Are you going to be tuning in?
Absolutely.
Yeah, I think our family will as well. Just kind of see. It's gonna be an interesting night. Let's put it that way. All right.
I will give a plug before we wrap up here. We'll be doing a second part to this webinar series featuring both Bill and Rick on Wednesday, October 28th. That webinar is actually scheduled for 6 p.m. We felt as we got that close to the election, people would prefer to have a webinar discussing the 2020 election and the impact on the markets closer to happy hour. So we really appreciate everybody tuning in today, and we look forward to getting back together. Great job, Bill, Rick. Look forward to the next time.
Awesome. Well, thanks, everybody. We appreciate it. And as always, if you have any questions, please reach out to your advisor or to myself or to Shannon, and look forward to talking to you again soon.
Thank you.